I want to talk about fear in the markets and fear in the silver market, but actually fear in all the markets. There's a lot of fear going on all the way around. That's why we're seeing all these fluctuations. And the Federal Reserve is very carefully, you know, preparing its words about the policy about QE, how it's going to play out. What are going to be the exact parameters so, the markets don't go haywire one way or the other. But if you start thinking about it, the fear factor was big in the markets because Bernanke didn't say he was going to end QE, and that QE didn't in fact end. He says it may end, or we hopefully will be ending next, say in 2014 or maybe late 2013. We'll start tapering it back if the numbers look good in unemployment and production, goods and services. It's not really saying he's ending it, but I was comparing it to like H.G. Wells' presentation of The Martians Are Coming. The people were jumping off the freaking roofs right away, so they were really freaking out. But there's a lot of other areas in the markets that are fearful, and there's been the second largest redemption in bonds in ever. If you look at this chart right here, and this goes all the way back, 12 years. So we had that in the financial crisis. So this is almost like another financial crisis coming up. There's a lot of hints that it is. Now the equities don't look like they're getting hammered as much, but I don't know. By the time I upload this video, I don't know what the results are going to be, but before the opening, actually the S&P today on the 28th of June was getting hit, and Nikkei in Japan was getting hit. So, but it's like, I don't know where they're all running to tell you the truth, because it's like, it's like, if you're looking back, this is like by outflows, by class, first off, in the bonds, there was 23 billion in outflows. 58 billion over 4 weeks. That was the most they outflowed, Now, actually, there's another way interest rates can go up is by, not them setting. In other words, if the bonds are discounted, in effect, you have a higher interest rate, right? I mean, if you buy something that's a financial instrument for, $100 or something, right, and it pays 2% interest, but you got it for 80. Well, it's paying like 2-point-something% interest in effect, right? So, that's the other way interest rates can go up. Also, equities. There's been a lot of outflows in the equities, too. Precious metals, there's been a lot of well, electronically. See, precious metals is really freaking weird because precious metals, there's been 20 straight weeks of outflows. Now, compare that to bonds. Bonds is 23 billion. Precious metals on the electronic markets is 2.8 billion, which is mainly, the gold. It's not even it's palladium. I don't know what's in there. I'd have to get some kind of number for that, but it's like minuscule, But the bonds, they're moving out of the bonds, they're moving out of the equities, they're moving out of precious metals, but they're not necessarily going into cash. 53, there's been a year, a little over a year, 53 weeks of inflows to leveraged loan funds. So, the munis, they're exiting the munis, largest outflows ever from IG funds, largest outflows ever from muni bonds. So they are exiting the bond markets left and right. So, I guess that's a way interest rates can go up. If the bond is discounted, sold at a discount, in effect, you're getting a higher interest rate, right? But that's not what the interest rate was at issuance, So, there seems to be a lot of fear in the markets left and right, and that's why the Fed is very carefully crafting its words. Basically, it was Jeremy Steins who was basically saying what's going to happen and trying to outline exactly what the policy of the Fed is going to be. You're preparing, what's going to be said at the next FOMC meeting and stuff too. But The other thing is the yield on a 10-year Treasury note hit a high of 2.64% on Monday, just as several days ago this week. But you know, the bonds have rallied now, and the 10-year is now trading at two. It's rallied a little bit. So, but still, there's been a massive outflow of bonds from the bond sector, and it looks like the equities. And if you're looking at this chart, it's kind of interesting because the only other time we've had this really super big sell-off in the bonds was 2008, 2009 financial crisis, right? So maybe something's coming up, and not that Ben Bernanke's going to announce this right away. He's not going to say oh, they're going to do QE. Obviously, I think there's a lot of people that know in the background what he's going to say, and they have inside information. This guy can move the markets like crazy. But I think QE is going to start coming on board in a couple months, or maybe at least talk of it, where psychologically the people will be, speculating upwards. But there's so much bullshit in the financial world, and like I said, like I was pointing out yesterday, they're just a bunch of salesmen. It's like they go to school to get the initials, they go to school to have a degree, and that makes the public trust them that they know what they're doing, right? But then they get away from that, and then it's like a marketing type thing. And it doesn't even matter, even if you're in business and you're not selling for somebody else, even if you're in your own business, it's still a marketing thing all the way. So, they have to have your money under their management all the time. And, these people are probably, something goes wrong, they're just going to be scarce. That's what I figure. So, you're best off at the precious metals in that way because it's a backup to the backup to the backup. But like I've been saying all along, you don't want to be like 100% into the precious metals. That's stupid. You don't want to be 100% into anything. You could be pretty hard. You could be more than 50% into them. I think that's really. But you know what? You better be psychologically prepared to freaking have a lot of ups and downs. And I've been saying this from day one. So I ain't gonna like it if it goes lower than this. But it's 18 something, 1819 has been a major support area again for talking about silver, of course. I'm not even well, I have some electronic gold, I have some physical gold, but I don't know. I'm not. I think what's going to happen with, especially with something with gold, is like when they have the budget fights coming up again for the end of the fiscal year for the government. Raising the debt ceiling and all this kind of garbage. I just think there's going to be more right there that's going to scare people into gold. It's going to move up again. It can move up fast too. I mean, you just don't know. I mean, the metals have. Let me put it this way: the commodities have always been something that scares the retired investor. I would say that because it's volatile. It's just really. I'm not even saying nothing really, but I guess the average person doesn't see it that way. The average, actually, the one that maybe I'm looking at this channel, they were thinking about silver as a safety, physical silver, everything's going to crash. But actually, the metals have always been, any commodities, oil, it don't matter. They've always been known for their volatility. They go, and silver has been known as the most volatile of just about anything out there. But there's other things too. Even in the agricultural world, coffee, soybeans, they're all over the place. Commodities have always been the thing where, like, people want a steady income. They don't want things going one way too much, or they don't want to risk their money too much. They steer away from commodities. That's always been it. That I knew. I've known that for like a decade. You know what I mean? And it's like. I used to say that to the people in the silver world, and I used to get mad at that. But I guess now they're probably figuring, yeah, no shit, that's pretty true, But it's like that with all the commodities, man. But the thing is, they spring up hard because you just can't, turn on a switch and produce them again, because they either come out of the ground, with metals, or they're grown in the ground. Like, say, actually corn product got destroyed due to drought. You're gonna have to wait to grow this stuff again, right? You don't just say, hey, I want to have some more corn here, it doesn't happen like that. So commodities can have some serious fluctuations due to other factors. And, the market is actually going to crush the commodities so bad in the metals area that a lot of the mines are starting to, they're not necessarily shutting down, but they're scaling back operations a lot. That's what you'll see. They'll go on like skeleton crews to the max. They'll just cut back. They don't necessarily shut down. But then, if the demand is there, it's going to be tough for them to freaking just start it up again. It's not like you're, it's not like you're freaking doing haircuts on people or some shit. You know what I mean? It's like you just can't freaking turn on the switch that fast with commodities. So then all of a sudden they go like this. And that's why they've always been known as being extremely volatile, and they call volatility risk. And it looks like in general in the markets, there's been a major outflow from the bonds. It looks like there's outflows. Well, there's major outflows from the munis and municipal bonds. There's also major outflows from equities, it looks like. Especially, something's going on this morning before the markets open up. I don't know what, by the time I upload this, we'll see if the markets are up or down, but they look like they're going to be down. But there's other things they can actually invest in. These aren't the only investments out there. There's a lot of other things they can invest in. But, and actually a lot of people with bucks, they might invest in tips, Treasury inflation protected securities, if they're afraid of inflation versus even gold. I mean, it's not the only thing you got to buy, gold, but I have a tendency to believe that there's so much BS in the financial system. That thing with I said this a gazillion times, but I think that Mark Farber says that there might be a catastrophic collapse sometimes in the future, where just the whole damn thing has a heart attack or something. He's probably right, because being in the accounting and finance world, man, I've seen so much. It's like Max Kaiser alluded to a lot of this about what he saw. I saw a lot of shit I never saw, but I mean, it's like, a lot of people don't realize what really goes on. They just know, they wouldn't understand it. And that's the whole idea. You're not supposed to understand it. Like derivatives. And that's probably going to be the bubble that breaks the whole thing. But right now, there is a lot of fear in the markets. It's just not in the precious metal markets. There's a lot of outflows going from the bonds. It even looks like the equities, too. And the precious metals. But not outflows from the precious metals in the physical sense. Weird, man. So, you're actually jumping on when you're buying more physical metals. And you don't have to, say, every time you got some money, you got to buy physical metals. I'm not too hyped on that right now because I got enough of them, man. But I decided to get a little bit more anyway. So, but, because the price was right, which was cool, for that. But I'm not going to necessarily go freaking out like I got to keep buying silver every freaking 2 seconds. I'm not doing that. Because, once you're built up to a certain stage, I ain't worried about that part. That's like the backup to the backup to the backup. So, but again, there's a lot of fear in the markets, not just in the precious metals markets, all across. It's the bond markets, the equities, the municipal bonds. But in the precious metals markets, even though there's outflows electronically, there's like a lot of people buying in metals themselves. That is weird. I don't know.